Welcome back. It's the second day of Christmas and I'm guessing you guys are ready for another tip. So let's go to the stocking and see what tip we pull out today. So on the second day of Christmas, We Make Mince gave to me. Oh, I think I've got two. We only want one today. We only want one. Here we go. Okay, this is an interesting one. So tip number 23, margin and how to use it for your benefit. Your benefit. Not your brokers. Okay, so with CFD accounts, contract for difference accounts, you always trade on margin, so you don't have to put up all of the money basically. It's a little bit like a mortgage on your house. You only put a deposit down, but you pretty much own the house. If the house goes up by 10 grand and you sell it, you give the money back to the bank and you keep your deposit and your profit. That's how contracts work on gold and things like that. So the problem is that sometimes when people first start trading, and maybe sometimes when they're into their careers, they sometimes get a little bit over ambitious and they over leverage, they overexpose themselves. And if you start getting, emails or alerts from your broker saying that your margin's fallen below 100%, make a margin call. We've got on our discipline DVD what to do in them circumstances, but this video will hopefully mean you don't need to get in that circumstance. If you are getting a margin call saying that your margin level is below 100%, then you are in a way too big position for your account size. And this is an example. Do you know what? Me personally, I can't remember the last time I fell below 100% on my account, because whatever amount of money I've got in there, I only ever use 50% of it. 50% of it is like collecting dust on a shelf. It's just there. I don't use it. If I've got, I don't know, let's just say I've got £4,000 in my account, only 2,000 is used on it. And I don't mean 2,000 is out on positions. I mean, I've bought my positions or sold my positions, whatever. If the market goes against me, I've still got 50% of my money in there, because if you are over leveraging, it means you need to buy the low of the day. If the market starts to go down and your broker shuts your trade off because your margin level's fallen below 80% or whatever the brokerage rules are with the accounts you have, then the market might go up and you might actually have been right, but because you was maybe too greedy, you over leveraged, overexposed yourself, you have to get that position right. You have to get in at the right price. Whereas if you give yourself a lot of freedom, we can buy it and we know the market can go down quite a bit and we're comfortable with that, as long as technically we should still be long. So when it comes to margin, don't overexpose yourself in any market. We always use, as I say, we always use 50% of our credit, because that's a good way of putting it, credit. 50% is never used. So that is a good way to use it to your benefit. Companies love you, the brokerage companies love you overexposing yourself, because the odds are even more against you. If you can only allow the market to go down a little bit against you before they shut the trade off, then you are really ice skating uphill when it comes to trading. So when it comes to margin, be sensible, don't be greedy, don't go mad on the position sizes, because you are making it harder for yourselves.